So we are delighted to be joined by James Anderson today from Baillie Gifford. James, thanks so much for coming along. James is, alongside Tom Slater, the joint manager of the Scottish Mortgage Investment Trust. And Scottish Mortgage, with a market cap of over £7.5 billion, is the largest equity-focused investment trust on the London market. It itself has a very long history, but its success under the tenure of James and his team in our view comes from the genuinely long-term approach that the team use and the focus on a high conviction portfolio of often highly innovative businesses, but all of which have proven to have a sustainable competitive advantage in their own industries. For those that are less familiar with the story, James recorded an interview with us back at the start of 2017, which ran through a lot of the key features of the investment approach that the team uses. And you can find that on our website for further background. However, for today, James, to kick off, since our last interview, so 18 months ago, performance has been extremely strong. And I mean, as with all equity investments, there have been some setbacks along the way. It's not been an entirely smooth ride. And perhaps relevantly for this portfolio, some of those setbacks have involved the debate around the collection and use of personal data, and perhaps the social responsibility of some of those big network businesses that are part of the portfolio. I wondered if your stance on perhaps the regulatory issues around that have changed over the last year or so.
Well, firstly, thanks very much for inviting me. I think that they have evolved quite a lot, but it's quite nuanced. So what you may well have noticed is that we have in particular reduced our holding in Facebook quite a large way, which I think is the easiest way into the conversation. We have become concerned that advertising-driven business models, or solely advertising-driven business models, are exposed to many temptations on this field. Now, the offset to that would be that I was able to talk to Mark Zuckerberg about this a couple of months ago, and it seems to me that his both admission and determination to change, that they had abused this position and that he didn't realise the disadvantages as well as the profound advantages of communication, are something that we should take very seriously. You know, that's a message that some investors don't really like because it will have upfront costs that will substantially dampen profits for probably the next 3 years, but to our mind, given the long-term focus, is entirely the appropriate response. On another level, to be honest, we worry that some badly thought through pieces of regulation will simply end up making the dominance of a few companies more persistent rather than less. And going in another direction, I think at times regulation is actually creating, or the fear of regulation is creating opportunities rather than a cause for anxiety on our point. And I think I mentioned it when chatting to you before, but not in this format. In particular, this notion that regulating Amazon would be a bad thing for shareholders seems to us quite questionable. You know, probably the first thing that happens is that they have to spin off AWS. My view would be the share price would likely soar on that news rather than anything else. And if you told them they had to have regulation on the core physical infrastructure for e-commerce in America, that would mean that they had to make a high return, whereas at the moment they run it at break even. You can question which is the right long-term policy, but the notion that Amazon falls apart because of this is, I think, slightly questionable.
My next question was not entirely unrelated, but on business culture, and I know that's a big part of the kind of initial due diligence that you look at in terms of either the founder of the business or the business itself. What are the key kind of, if there are any key features of business culture that you're looking for?
Yeah. I think you're right to pursue this because it's a very easy topic to bring up, but it's a less easy one to define what one's actually looking for. And can I try and picture the highest possible level? And I don't mean by that to be vague at all, in fact, rather the opposite. I think what one's most looking for in the ideal company from that point of view is a company that has a profoundly differentiated view of what leads to competitive success, but that in turn is built into the business model. Now, you won't be surprised that I think the easiest one to talk about it from is Amazon, because Amazon, I mean, it's not just because in any way that Amazon's been our largest holding for so long. It is, in a sense, because I think it is the company that articulates the hypotheses most clearly of all. Now, if Jeff Bezos runs the company as he does on the basis that you need to experiment, and on the basis that, as he says, if you see a 10% chance of making 100 times your money, you should take it every time, with the knowledge that you will frequently fail. Well, what do you need to do? You need to give your company the freedom to experiment if you're doing that. So hence, for instance, the two-pizza principle, that you should never have teams involved who can't be fed on two pizzas, admittedly American-style pizzas, but it's still a small number of people, and that no one else can block it, because that's how you get that type of experimentation. So it's a clear business philosophy that mutates into a day-to-day running of the business in a different manner, and a very explicit manner, that I think is the most critical ingredient in what we're looking for.
So China's remained a big part of the portfolio, a number of holdings there. And I understand that you've had research trips to China in the last year or so that have resulted in further investments being made. I just wondered if there are any kind of key takeaways that you've had from those trips that you could share with us.
Oh, absolutely. And I would put this in the context that we're even more excited now because, I think one can understand why people are currently selling emerging markets or Chinese assets, but we think it is profoundly misguided in the long term. So we're very excited about the opportunities available. And we are both adding to current investments and buying some new companies which we're excited about that we've owned in unquoted form before. I think that the hypothesis that I would like to put on this is that from the point of view of human or physical capital, from the point of view of business models, from the point of view of the environment being supportive, that the comparison we need to make is that there is no real reason why over at least your investment career, I may be a bit old for this, that China shouldn't be as rich as America on a per capita basis at nominal rather than underlying exchange rates as well. So I think that's the scale we're talking about. And I think the clues to this are you look at the sheer power of what's coming through the system. So 4 times as many science and technology graduates as America. Companies with a all-embracing and at the same time very much supported by the populace and the governance structures, ability to move onwards here. And I think really people need to understand the extraordinary scale of ambition and pace of change that's happening out there.
It's easy when discussing the Scottish mortgage portfolio to kind of focus on those very well-known or increasingly well-known kind of dominant consumer-facing names often, and all those kind of very high-profile businesses coming from Silicon Valley or increasingly from China. But there are a number in the European part of the portfolio, perhaps lesser well-known, but equally as innovative. Could you maybe touch on one of those?
One or more, because I do find this fascinating, and it's kind of you to draw a reference to it, because in a sense, when we're talking about being long-term and having management skills and business underlying competitive advantages, I think it's actually been a great experience from our point of view, the relationships that's led us to it in different areas, and where these companies appear to be able to bring many of those outstanding characteristics to bear on seemingly less exciting areas. So, I can go at one end to ASML in Holland. How has a start-up, near-bankrupt start-off, spun off by near-bankrupt as it was at that time, Philips, made itself the single most important feature of the continuation of Moore's law, and a monopolist rather than just an oligopolist in lithography systems. And I think that is an example of a company run by a scientific genius who never wanted to be CEO, but is genuinely at that level, with an astonishing capacity to see where its own skill sets is, on the other hand, to acknowledge where it needs to buy in services and cooperate, and at the same time to cooperate intensely with its customer base, and the customer base of the scale of Intel and Samsung and the likes, who yet are incredibly committed to them. And I think it's a story well worth investigating. But you can go to the other end of the extreme, and I feel, if you don't mind, I want to add another example as well, because it's one full with sadness as well, in that we were first shareholders in Fiat and then subsequently in Ferrari. And we were actually fortunate enough to be having a discussion with Sergio Marchionne literally weeks before his heavily concealed illness eventually took its toll. And I think that is a classic example of a company in a phenomenally difficult industry, in a phenomenally difficult political background in Italy, that managed to structure itself to think about where it was advantaged in the world. And if there's one lesson that I think Sergio Marchionne really drove through, it was, as John Elkann said of him, that he was a man who told the truth about the company and could say materials that in most environments you would not be allowed to say, so that most of their production was never going to make a profit, that they needed to focus on specialized areas and drive their leadership in those areas. And I as I say, it's been a great sadness about it, but I think it's somebody who managed to create tremendous shareholder returns and great, deep, abiding respect for what he's done from very unlikely materials. It stands out.
Perhaps just one final question, if I may. You and your team have talked increasingly about the investment in academia, perhaps to get a kind of information advantage. I wondered, what's your ambition with that, and are there any maybe one area that has been highlighted in the recent past from that experience?
Absolutely, and I think that it's hopefully something that we can talk about in future as well, because I think we're only at the beginnings of this adventure. Now, as you kind of say, in the past, we've seen our role as being able to drive returns off being truly long term, and there are lots of spin-offs to that, thinking about asymmetric returns. But increasingly, we do believe that it's nonsensical, this belief that the markets are efficient. It incorporates all the noise, for sure, and if I may, the noise particularly emanating from London and New York, but it doesn't incorporate what we actually need to know. So if you told me today what the next decision of the Federal Reserve would be, or what the heck happens to Brexit or Trump's tweeting, I'm not even convinced that I could actually make money out of knowing those things. But if, on the other hand, you tell me about the deep underlying change, so let's go back to the ASML example, which is one of these. So if you'd known in 1965 what Gordon Moore thought about the progress in semiconductors, you would have been able to make a great deal of money out of it. We think you can know those type of events. Going back to ASML, they said this actually dates back to 1900. But the Santa Fe Institute, who are one of the main parts of what we do, have done is extraordinary work on the progress of these underlying technologies and where it goes on in the future. And I would perhaps again, if I may, two examples, one specific and spinning out of this and one more general. The specific one would be that amidst all the noise and fury surrounding Tesla, we are extremely confident that the structural progress towards lower and lower battery costs and higher performance, and the same for the solar backgrounds, is sustainable. And frankly, we don't know precisely when. It may be now, but it may be in the future that happens. But it gives you a great deal of conviction and confidence that you carry on investing. But I want to give another one because I think this is also about the structure as well as the specifics. It's, I've often tried to say that how we think is as important as much we think. And a lot of this material is best summed up in Hendrik Besenbinder's academic research on the nature of returns in the American stock market since 1926. And as the title probably gives a hint, do stocks outperform T-bills? Well, the answer is no in most cases. What you need is the extreme outliers that have made those equity returns. So I think it's given us a lot of strength and confidence in pursuing that. And we now work with Professor Pessenbinder about what characteristics those companies have had, whether this data is replicable internationally. And I think it informs the whole mental approach. And to be honest, I find that at least as important as the specific examples, though the specific examples do exist.
James, that's been really helpful. As always, thanks very much for coming in to join us. If you'd like any further details on the Scottish Mortgage Investment Trust, please do contact your investment manager. And thanks very much.